There is a famous optical illusion where, in the same portrait, some see a demure young woman and others see a wizened old hag. Once one interpretation is fixed in the mind, it's hard to flip to the other, and currently global fund managers see Japan as the repulsive crone. Over the past 12 months, foreign investors have sold about 10 trillion yen's worth of Japanese stocks, shunning the promise of between 7 and 10 trillion yen of government stimulus, record payouts to shareholders, and a steady pickup in domestic M&A. The now standard line is that Japan's appeal is only visible to the outside world when the yen is cheap. The very close correlation between the TOPIX index and the dollar-yen rate support that theory, and the optimistic call is for a sharp turnaround in the market if the yen weakens again. But that logic is looking broken. Global funds are not only shunning record payouts and stimulus speculation, they are choosing to remain sellers into a market where the central bank, the government pension investment fund, and corporate Japan via share buybacks are dependable buyers of the market. Analysts at Goldman Sachs see that trio collectively buying 23 trillion yen of domestic equities this year. Less than a year ago, these were all things that made Japan attractive. Now it seems they simply highlight the warts. The issue, as summarized by Akira Kiyota, the president of the group that runs the Tokyo Stock Exchange, is that everything these days is unusual, from negative interest rates to the Bank of Japan owning 58% of the 15 trillion yen domestic exchange-traded fund market, and then calling on asset management industry to invent new ETFs for it to buy. There is appealing unusual and there is ugly unusual. Global funds could be treating all this as unambiguously supportive, or they could decide that they are watching increasingly desperate emergency measures with no happy ending. It may take more than a cheap yen to switch from beast to beauty.